Time to see what's on the radar for Jeff Hall, Senior Financial Advisor at Manulife Wealth. And right now it's Big Tech CapEx. Sounds like a team. Big Tech CapEx is on your radar. Lots going on with that. Some huge numbers being thrown about.
Well, actually, the biggest numbers in all of history for capital expenditures. And it's interesting because that's one of the first things I look at when quarterly earnings come out. I go right down to that capital expenditures line. I say, okay, what are they spending their money on? How much are they dedicating, not just in the rearview mirror, but what's coming? And this last tech amount, Amazon, $200 billion, Microsoft, $164 billion, Google, $180 billion, Meta, $120 billion, Oracle, $63 billion. This isn't million, this is billions of dollars. Yep. And these aren't small increases. We're talking like doubling over the previous year. In some cases,
well, didn't one group of them go from 165 million to 400 million last year to 400 million this year?
It's crazy. So on average, they're almost doubling their spending almost every year. But it is an AI arms race, so they have to stay at the forefront. And like we talked about earlier, they have FOMO, they have fear of missing out. And not just the AI war of America and Europe, it's battling China with DeepSeek and all of their AI, with Huawei and the things that they're working on as well. So it's a fascinating field, but there's a lot of interesting things behind the CapEx spending that was important.
All right, what are some of the things behind it then that caught your eye?
Well, one of the things is with capital expenditures, whether a farmer has to buy John Deere equipment to farm, he's got to buy seeds and fertilizer. It means they're spending a lot of money up front with the hope that at the end of the harvest season, they'll get to reap the rewards of the benefit of what they planted. No difference with capital expenditures, but there are companies that have to spend a lot of money just to maintain their companies. Usually it's not tech. Usually it's companies that generate electricity that have to send that somewhere, as an example. All of a sudden an ice storm happens, knocks down all their wires. Now they got to maintain, redo wires. So just to maintain infrastructure, sometimes there's a lot of spending. But with the AI field, as an example, these massive data centers are huge and immense. But here's a secret that a lot of people don't know about. You can get a free crystal ball to see into the future because one of the biggest and the gem of AI is Nvidia. They're everybody's dance partner.
Yeah.
But the blessing people have is Nvidia is the last of the big tech titans to report their quarterly earnings. So the caboose at the end of the train. They're a month after the Apples, the Metas, the Microsofts, the Teslas, et cetera, that use Nvidia as an example. So you can look at all the capital expenditures for all the big tech titans, and then a month later comes Nvidia's earnings. Everybody goes, oh, it's a surprise. They made so much money. They just looked a month earlier where everybody was spending their money. It just sounds like Nvidia, all the way down the list. So sometimes investors, just by good fortune, can see where quarterly earnings line up. And you get that kind of clearing of the fog even before earnings come out to see how are things actually going? Are companies stepping pedal to the metal on the gas, or are they pumping the brakes? In the case of AI right now, it's full pedal to the metal all the way.
And with Nvidia, is anybody on the horizon to challenge it?
Not really, and they keep evolving. Like, for instance, the humanoid robots coming out from Tesla, they're using NVIDIA. NVIDIA's going to be in a lot of the self-driving cars that are coming out. So it's not just the data centers. And remember, 14 years ago when I was thumping the drum here about NVIDIA, it was a video gaming chip company.
Yeah.
There was no AI data centers and things. So they have this ability as the world's largest publicly traded company to pivot and adjust their companies along the way so quickly. It's amazing that way. But do remember the longer term future that's coming that's really exciting for all of these businesses. It's not just AI. It's when quantum computers marry the AI.
Yes.
It's a whole other stratosphere of breakthroughs in science and physics and medicine. It's going to be truly incredible with what's coming down the pipe.
You're just excited about that. I want to ask you about Alphabet, though, selling the sterling and Swiss franc bonds and the 100-year note.
Yeah, it's a little longer. I don't know if I'll be around to collect on that one. But you're going to see a lot of companies do this. Disney did this a couple of decades ago. Sometimes you have these companies issuing these very long-term bonds as a way to finance themselves, which is kind of smart because like a company like Alphabet, they've got tons of money in the bank. They don't need to finance anything. But if you're going to pay a dividend, Apple does this with Ireland as an example. If they repatriate a bunch of money home and go to pay it out in a dividend, they're going to pay a bunch of tax to pay a small dividend when they can borrow at less than 1% through their bond and just pay the dividend. So there's all these different ways they can maneuver financing around that benefits them, even if they don't need financing. Sometimes it's worth dipping into that field. And a 100-year bond is kind of interesting because it's long-term. And for those that want something like that in their portfolio, it could be generational. Could be interesting.
Will there be interest for that, do you think? I mean, they had huge interest for the $20 billion that they put out. They got, I think, $100 billion worth of orders for it. So will there be interest in a 100-year?
I think so. I think you're going to see it sell out, actually. And it might even be oversubscribed for. And again, they can adjust the amount up and down depending on the interest level. But I think it's kind of interesting. And once Google does it, other people are like, that's not a bad idea. You'll probably see other people join the party and have something similar. Maybe not a century-old bond coming for maturity, but maybe something shorter, maybe even a 50-year as an example. But you see other companies that could use that as a novel way to finance their future.
Any concern that this is a bad sign?
I personally like to see no debt at all times. I prefer to see no debt for any reason. But there's a lot of companies that are seeing an opportunity right now, partially because of the big, beautiful bill, as it's called under Donald Trump, is now companies can write off 100% of their capex in the year in which they allocate money for that, versus, say, depreciating over 10 years, depending on the type of spend. So that's a big difference. And even citizens now, with the big, beautiful bill, as an example, in the States, if you're buying an American car or truck and you're financing it, it's 100% tax write-off for all the interest that you're paying because you're buying American. So you can start to see these little silos of incentives that come along that could be very interesting, both for investors and sometimes for consumers.